Well, hello, folks. I'm L.A. Little, and this is your daily NeoTA wrap. We take a look at these markets, and we do it from a neoclassical perspective. Each time we ask ourselves what happened today, and what does it tell us about the coming ones. I do this show 4 times a week, every Monday through Thursday. It's broadcast at or before 10 o'clock Eastern Time, archived on YouTube under the channel L.A. Little. You can find us there and view us anytime, anywhere, any device, at your own convenience, of course. Take a look, subscribe, and get this stuff emailed to you or alerted, depending on how you get your alerts. As far as these markets, it was another down day. They tried to lift them again, and it's several days in a row now that you've had attempts to move higher, only to find sellers on the way. So Dow down another 0.5%, a little over 0.5% here on the SPX, but you had down 1% or more, just slightly more, on the Russell and the Index. So another down day. Pressure continues, and where's the pressure coming from? Well, it's oil. As you can see here, down another 4% today. Oil just continues to crumble. If you're looking at the futures, they were down almost 5%. Dollar rises on that news. You actually had gold tumble down 2.5%, $30. Bonds couldn't lift, right? Kind of selling just across the whole spectrum here. Junk bonds actually made another new low, but spiked up at the end. We'll take a look at those guys here in a little bit. But essentially, the story here tonight is oil, and oil has been the story. I latched on to this story a long time before most folks did. I was highlighting it back in November, back when it was starting to take a big spill, and that was, it was about November 15th, I think, somewhere in here. I did a radio spot on it, in Boston, WRKO. $29 down to 21 now. That's an $8 move off of 29. That's a pretty good percentage since I started talking about it, and it's just in a free fall. I mean, anybody in this is really getting their head handed to them, especially if they're in it in any way large. This has the stock market hostage, completely hostage. There's no other way to view it. And so if we go over and take a look at the indexes, you're going to see breakdowns starting to take place pretty much across all of them. So here's the S&P 500. Last week we'd already had a trend change. Tonight we're going to have another one. We break this swing point low. So you can see the swing points starting to fall here, and those swing points are leading this market to newer lows. So we're going to have a bear market on this time frame, which is the daily. On the weekly, it's actually doing a full retest regenerate. So if we look at that, here's the retest. Low on this is 1978. Got down within 4 points of it today. That's probably going to test again tomorrow. It still does not look like it's done. Until you get some sort of a reversal, you just have to assume the short-term trend is going to continue, and that's what it's doing right now. Until you get to a spot where it makes sense to flip around, this is the spot when you look at the weekly, in terms of it should try to turn. If it doesn't, no longer will it be a bull market on the intermediate term time frame, but it will be some sort of a range trade on that time frame for the near term. So that's the S&P. The Dow had already gone into bear market on the daily. Did that back here on the break last week. Now it's toying with its swing point high. If you look at it, it actually isn't showing as a swing point high, but if you look at it here, that was the last high. You're coming into it. Probably not going to have enough volume, but you are coming into it. This one could trade down to the bottom of that, which is roughly 17,000. If we look at the NASDAQ, the NASDAQ comes down pretty hard again, breaks 2 swing points. That's going to turn it to bearish on this time frame. That's also coming back to get to the let me find my chart here, get to the highs on the weekly, and you can see it coming into those now. And if you look at the NDX is doing the same thing. Breaks one on Friday, breaks another one today. That one goes to bear market as well. And then if you look at it on the weekly, you can see it's coming back to those highs. So they're all coming back into a spot where we should probably see buying support, especially given the direct down nature of the move. Now, if you don't get support, then it's worse than it looks. I don't know right now that it looks that bad. It looks like a normal type correction taking place. But yes, it could turn into something larger. And yes, it could turn right around and go straight back up to the highs again. I mean, how many times have we seen that? So I don't think this is where, you hunker down and sell everything you have. It's not that point. But you're certainly starting to see the damage on the short term. You're starting to see it come back on the weeklies to areas that should be bought if they're going to be bought. So, we're reaching that point where that's either going to happen or this market's going to tell us that something more serious is taking place. If I look at the sectors, I'm starting to see the risk come off here as well. IBB, you can see it coming off there. IYT really just kind of held today. We did a spot on it, looked at it. The XLE breaks down farther, still no bottom in sight on any of the time frames. The ones that have been hit the worst, XLI is down a little bit more tonight. XLB was the other one. That one's down a little bit more again. XLK, large cap technology, can't find a bid still. Right across the board, they're all getting hit. They're all starting to break down. So you've got breakdowns on the short-term time frames across all the sectors, or most of the sectors. You've got it across most of the indexes, or actually you have it across all the indexes at this point on the short-term time frames. And so, that bearishness that you see in individual stocks that we've seen, and that little bit of a pullback that started with energy that now has spread to everything, has certainly made itself known on this time frame. And though I don't know that we should believe that just because the dailies go to a bear market on this time frame or to a bearish trend, that doesn't mean that they have to go there on the weeklies. What you're looking for on the weeklies, and we can pull this across and just look at the weeklies, is you're looking for breaks of swing point lows to tell you that you're back into some sort of a bearish move, or at least a sideways move. To get there is a long way, folks. Remember, we just went up 14% almost. Depending on what you're looking at, it's anywhere from 12 to 14. So to get back to the lows and break them would mean that you'd have a total cave-in. And I'm going to just pop up the weeklies across the board here. That's across all these sectors. That's across all these indexes, right? I mean, just look at this. Look at how far one has to go to get back to a swing point low. To assume that we're going to get back down there now is to assume a crash. I don't think that's realistic. So you have to assume that somewhere along the line you're going to find some support and a bounce. It's the failed bounce you have to worry about if there's something to worry about, and that's the thing that we should be looking at as we come back up once that up move takes place. If I look over the world markets, and in particular, I want to look at China, and here's the HCAP China shares. You can see they're coming back. I've got the weekly up here. Let's pull up the daily so we can see a little more granularity. So still kind of an ABCD structure taking place here, or attempting to take place, but didn't quite take root. But this one's going to be an important one tonight. They've got some numbers coming out tonight that will probably show worse numbers, at least that's the expectation, which would simply say, hey, China's central bank's going to have to ease even more, and if we're going to see easing, it's there, it's in Japan, and it's in over in Europe. And if we go look at Europe next and take a look here, you got the CACs coming back in to test the highs of the high volume lows from this October. And so that's a big move there. If we look at the DAX now, the DAX being the strongest one, the DAX has held on, and the DAX isn't showing that kind of destruction yet. So we'll see if the weaker ones in Europe can take the strong ones lower, or if it's actually going to be the other way around. But in all these weaker markets, they keep arguing for more central bank action. And I would be surprised if we don't see more central bank action right across the board in Europe, in Asia, and I wouldn't be surprised to see the United States not do, more easing, but back off this ideal of raising the rates, because, when I look around the world, nobody else is going to raise rates, and if we raise ours too fast, it's going to have an effect around the world. So we may see Yellen actually back off the whole ideal of raising rates. Maybe they keep that language in there. Maybe they replace that language with something that suggests that the rates aren't going to go back up nearly as fast as most people think. I'm not sure what that language is going to look like, but right now, with these markets doing what they're doing, it's kind of hard to think that Yellen's going to come out here and that the Fed's going to come out here and say we're going to tighten rates and we're going to do it in the spring, or we're going to do it, June. It's just hard to see that. I gotta think they're going to keep talking out of both sides of their mouth. So that's the world market. So in general, we have weakness. We know we have weakness. We're coming back to areas where that support should show up. If it doesn't show up, then this weakness is for real and it's more serious than we think. If it does show up, then the bounce will begin to unfold, and we'll see whether that year-end rally can actually take hold or not. Or, on the not case, we'll see if a failed bounce then really does turn into something nasty. Speaking about nasty, speaking about turning into something, Russia came out tonight, and I'm just going to highlight a couple things that happened. Russia came out tonight and raised their rates to 17%. That was a 62% increase. So you wake up one day from the next, and all of a sudden the rates rise on you by that kind of amount. So if you didn't get to your loan yesterday, you're in deep doo-doo in Russia, because you're certainly not going to get it today at a 62% hike. Why do they do that? Well, it's because of what's going on with the sanctions, and it's because of what's going on with oil. And that's the real fear out here that's starting to take place, is that you're going to see this bleed in oil start to totally affect, in a huge ways, those oil-dependent economies, Russia being one of them, but Russia, of course, having the problem of having exacerbated their own situation by causing sanctions with what they wanted to do in Ukraine and the Crimea region and so forth. But you have the same situation taking place in other countries. All of the Middle East countries that are oil producers are certainly having to tighten their budget. Venezuela, Iran, trouble spots in the world, they're going to get heated up. It's going to be a problem. Iraq will actually have issues as well. It's going to bring their revenues down. They're fighting ISIS at this point. I mean, it has a huge effect everywhere. It's not just, it's just not like oil's coming down. It's not going to affect anything. It has. Having said that, it's been doing that already. It's just now it's reaching a point where it's a little bit more critical, but certainly more visible. And we're better to see the visibility of that than in the junk bonds. So let's pop over and let's talk about the bonds and what's happening with them. Now we'll start out with the high yield bonds, which is the junk, and see that today they actually got a reversal on the daily. It was a hammer reversal underneath. The problem is volume expanded. So what this tells me is, yeah, this could be a reversal and you could trade higher for a bit, but this high volume low is more than likely going to see price come back and test it again at some point, and it could test it as quick as tomorrow. But that high yield debt did get the hammer reversal, may get some sort of a decent lift here before continuing on. This is broken. It's broken on all time frames. I did some research because, energy is the big thing out here. Junk bonds or high yield bonds that are typically, if a bankruptcy occurs, are typically the bonds that really go to zero. I mean, if you don't lose everything, you lose a large portion of whatever you had. And so these junk bonds are certainly a good indicator of fear about debt going bad. And that's what these are telling us. Now, I actually have a graphic. Actually, I don't have a graphic on it, but I did some work, and 15% of the junk bonds are energy related directly. So only 15% of this whole market is directly related to energy. And of course, energy is what's driving it. We've taken 10% off the value of the junk bonds. That almost wipes out, the 15% of the total that is energy, and it wipes them out to 30% or something. So clearly that's not all reflected in the energy debt. It's spilled over to other things. That's always the worry when these kinds of fast moves take place in important sectors or in bonds themselves, and that is that a contagion takes place, right? And then you get this unraveling, if you will, of the various debt markets, which of course causes other things to go bad. That's how some of these things get started in a very fast way. So it's definitely something to watch. And if we look at it from a yield perspective, on the yields, and I have a high yield chart here I pulled up. It's the high yield effective yield on the junk debt, basically. You can see it's back up to the levels that we saw in March of 2013. And I was actually going to pull over a monthly chart of the junk bonds. That's this level here. So you can see that spike down that came. You got the same sort of spike down that's taking place now. And if you go back and look at these others, the big correction, if you remember, was 2011. That was this correction. 2011 is way back here. So look at the difference between the yields there and the yields now. We'd have to basically go up another 120 or 30% of what we've already gone up to get back to those kinds of yields. Now, that doesn't mean it can't happen, but I just wanted to try to put this in perspective. Now, clearly, when you look at this chart, this has the sort of a rounding bottom kind of effect going on. Some sort of a pullback here, a bounce back up. Maybe you get over this and the yields get up to test this high. But right now, we haven't gone that far yet. It could get a whole lot worse if it's going to get back to the levels we saw in the 2011 time frame when the stock markets sold off, right? And they sold off a good percentage. It was about 15-20% if I remember right. Here's the monthly. Here's that drop. We went from 1370 down to 1070. So we lost 300 on 13. That's, what is that, about 25%. So we lost something, I think it was about 22%, 24%. So you can see that kind of a damage. If it's going to take place, this is going to go a lot higher, folks. So if you want to watch something, this is not a bad place to take a look at what's going on. Tomorrow, the rest of the week, Wednesday is the big numbers. We've got some industrial numbers, some PMI numbers tonight out of China. We got some more out of Japan a little bit later, or actually they probably have already done it too. We've got European numbers in the morning. You got the Fed on Wednesday. That's going to be the big number this week. You got quad witching at the end of the week, and you got a market that is sold off in front of the Fed. If the bulls really are in control, what better setup than what you have here? If they're going to do something, look for some weakness tomorrow to get bought instead of sold. And I'm going to end on that note with a look at the chart, a 5-day chart. And the point of this is to show you there has been late day selling every day. Late day selling here last week. Also here, you go to the next day, late date selling. Actually, it started pretty early all the way down. Continuation late date selling here today. It was early and continued at the end of the day. Every day selling at the end of the day. That's usually not bullish. Usually a bullish scenario is exactly the opposite. If you want to see this market turn, look for oil to turn, which it still hasn't. Look for the late day selling to dissipate and to disappear. If that happens, that's when you got a bounce taking place. Have a great night. Thanks for joining me. Tell a friend, tell two. I'm LA. This is, and it was, your daily NeoTA wrap. Have a great night, and I'll see you tomorrow. Good night.